Guys, ready to go? Bum 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 bum. All right, guten Morgen. Yeah. Welcome to Forex.Today, the YouTube community of 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance, because trading and investing, well, that's risky. It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hello, my name is Wayne. Hey, anyone from Joburg? Huh? The Wonders Club, huh? Joburg? South Africa. Good to see you. Oh, I'm trying to get my feet up. There we go. Good. Ready for another day of trading. So, how do you feel? Are you risk on or risk off? Did you answer the poll? No? Why not? Are you shy? Are you afraid? You're scared? Scaredy pants? Hey, answering the poll is anonymous. So if you answer the poll, everyone benefits. The law of reciprocity. So anywho, good to see you. Welcome to the show. Today, I imagine we will go through gold, oil, and Bitcoin, maybe some silver. We could look at the Dow. We can look at the S&P 500 and NASDAQ. We could look at DAX and FTSE in Hong Kong. There's a lot that we can do. Yeah, we can look at oil, right? D. McKenna says oil. We can do, gold, oil, Bitcoin, all of that kind of stuff. Yeah, for sure. And do you guys want to do crypto again? I've received requests to do more than Bitcoin. Can we do Ethereum and Litecoin and Ripple? Sure, I got you, bro. Here's the thing. You're the boss. I'm simply a humble servant. A tall, beautiful, humble servant. Yeah. Hey, by tall, right? I mean 5'9" 3/4. Yeah. But children look up to me. So anywho, so we can do whatever you want is what I'm trying to say. You're the boss. I'm simply a trader, an investor. Oh yeah, rocking the 5.3, huh? Yeah, cool. So anyways, let's just get on with it. Okay. Have you moved your broker over to an ECN yet? Every day I tell you, you need an ECN. Have you actually made a change? Supreme FX said, dude, Bootcamp, Trade Ours is awesome. Yeah, QuantBox is awesome too. Have you guys switched over to an ECN? Well, you should, and I recommend Trader's Way. You should check them out. Bum, 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 bum. So please answer the poll. Let me move my mouse. I got my cheap ass mouse. It's a jelly comb. And most of you are risk on. Okay, cool. Good. You're risk on. We'll start with the stock market as a gauge. And while we've been risk on for a while, I want to point out an obvious risk, but maybe you don't see it. But this buy zone says that this is the top for the month of May. Okay. Is Oanda an ECN? I don't think so. But I haven't spoken to Oanda in 10 years. So anyways, we are very topish. Well, clients, Mike, are outside the United States. So if you don't have any domestic clients, then there's no need for a domestic broker. But do you guys see the potential top there? Whoa, 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 whoa. So it's an exit point, okay? It's an exit point for many bulls. And the re-entry is somewhere around here or here, which could be next week. But it's still a giant like whoa, 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 whoa zone. Okay? So I'm assuming you know that, but if you don't, you don't. So now you do. Okay? You look at the S&P 500, and similar fashion, okay, same, only different. Okay, based on this entry, this is the presumed exit. What do you think? How many woes is that worth? 3 woes or 4 woes? Whoa, 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 whoa. Whoa, 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 whoa. Whoa. Hey now. Okay. You see? So even if you're risk on, know where you are on the map. Okay. How about no diggity, no Dow? You have to back out. I'll pop this to a daily. And the pattern, the same pattern on this one as the others, is this is the buy zone, and up here is the target, and we're here. So we're pretty close, but we're not quite there. Right? Okay. All right. Does that give you a sense that there might be a pullback coming? If you know, then you can be prepared. If you don't know, then you're just another victim. That's an old song, isn't it? Who did that? Was that House of Pain? I can't remember. That's an old song. Yeah, you missed the 90s? Dude, the 90s were great. The 90s were great to be young. It was such a great decade. Hang on. Hang on, I gotta forward this text, if I can. Forward. Yeah, I suppose they would have been different in many ways, right, Jim? But yeah, as long as you were in a good decade, right? Yeah, the music of the '60s were fantastic, though, huh? And you got a free trip paid by the U.S. government to see the world. How lovely. All right, so big move to the upside yesterday in Hong Kong. McKenna said 80s. Yeah, 80s would have been cool. I was young in the 80s, but I was in the 80s. So it was just the beginning of like the idea of tech, right? So you had like new wave music and video games and arcades. Talking cars. I mean, it was starting, right? And then, of course, like future age, the future was always dark, stuff like that. Yeah, there was a lot of coolness. I was a bit young, but I was there. Yeah. Nikkei finally moving. Yeah, so if we look at here, back into the zone. So if I go, how far do I need to go here? So I drew this quite a while ago, this support zone. We came down, we hit it, we bounced, and now we're back up. The issue, I suppose, like I'm assuming, Dakar, that you're a bull, but there is some bearishness potentially waiting in the wings. But as the United States becomes, let's say the theme of risk on continues for the next year and a half, at some point what will happen is American companies will become too expensive and some money will move to Europe and Asia to try to, because everything will have already been bought. Like once you own all the stuff you want to own in the S&P 500 and Nikkei, then the new money just means you just end up buying the same thing. So at some point you'll rotate out into international. You'll rotate out, into Europe and then Asia, and then these markets will continue to do well. So maybe that's happening. But this pattern of lower low usually sets up a lower high, right? The part that bugs me is this. And so I would look at it as potentially something like this forms, right? That's the part that bothers me. Yeah, buying dips, sure, but you got to know where you are, right? So anyway, so yeah, I got it. If you look, it's hard to see, but there is a positive slope, sure. So yeah, it's probable, but there's still some risk associated with it, right? The FTSE broke through, made a higher high. See, we were talking about this as maybe acting as a double top and the potential of it falling, and it never quite did. Okay, the pattern that's on this chart, remember, it's not my opinion. The pattern is if you bought in here, this is the target. So we're at the monthly projected high based on last month, but nothing happened last month. So you might say this is going to be a breakout month. And I couldn't disagree with you. That makes sense. So your next target, if you believe it's a breakout month, is up here. So let's just call it 9,000. And we're at 8,500. Okay. Yeah, Robert, they're just standard old pivots. So I've been trading pivots for so long that nobody traded pivots when I started teaching them. And now, clever gurus that want to sell you a training course, they came up with variations of pivot points, which is ridiculous because all you're trying to do is try to figure out what everyone else is doing. You're not trying to beat the market. So someone being clever is being too clever. So they might have some really cool pivot points based on some fantastic math, but it's unwanted. Not only is it unnecessary, it's unwanted. So anyways, it's simple. But back when I started researching pivot points, you couldn't even find the formula. That's how long ago. For all I know, I was the first one to publicly publish the formula for pivot points. And I had them, I paid for a developer to code them into the GFT platform back when that was a major brokerage house in the United States. And they called me and they said so many people were contacting them because they wanted my pivot points. And they didn't have them on the platform. Nobody had pivot points on their platform. And so I gave GFT my code for free to install in their platform and give away to all their customers for free. That's how the Wayne do. Okay? All right, so what's going on? It was interesting. At 7 o'clock this morning, we had a talk about oil. My Oxford training was very useful. It was very interesting because it was about, it's called the Algorithmic Trading Program. And there's two versions of it. Excuse me. me. 20 dwarves. Okay. There were two versions of the Algorithmic Trading Program. One was developing the code. And that's not me. I'm not that kind of person. The second version of the program was the management analytical side of evaluating algos. And, I'm previously a venture capitalist, so that makes sense to me to evaluate whether you want to invest into an algorithm, or more in particular, the way they looked at it is, the people developing the algos were running hedge funds. So it was judging based on the algorithm's performance whether I should invest or not. And so that's the route I took, sort of investment manager, CIO, Chief Investment Officer, leg of that. And it was taught by astrophysicists, which was really interesting because they're not finance guys. They're math wizards. And some of the hedge fund managers they brought in to discuss their algos, without saying any details, they were extraordinarily fascinating and made almost no sense. And, I don't really like that. Like they find patterns, but if you spoke to the person, they're like, we don't know, but the algo says buy. We don't know why or how, but they're just like, that's what it says. I don't like that type of investing, but nonetheless, you have to analyze past performance and try to predict future results, whether you should invest or not. In the same way where, as a VC, I would decide whether to invest or not. So it was terribly interesting. In the final examination was fairly simple. They gave you 3 track records of different algos, and they asked, would you invest, yes or no, and why? That was the final exam. And I passed that with flying colors. Yeah. So terribly, terribly interesting. Cool. Burns says, too much of a philanthropist. Well, my origin story, at least most of you do. My main goal for doing this every day is I don't want to be alone. So I'm most interested in just helping, entertaining, giving you tools. If I give you tools and you hang out with me and keep me straight and honest and focused, then I'm doing you a favor, you're doing me a favor. And you see all the money I'm investing into all these tools and services. And I hope you see, not only is it very expensive, but any contribution that you're making through subscriptions gets just plowed back in to the tools. It just pays for more developers. The developers should come in and thank you and hug you. Thank you, Bernd. Thank you, Robert. And so I hope you just see that. Thank you back. I love the positive feedback. I really do. But ultimately, my hope is that you just know. Yeah. I suppose that I hope I stand out and I'm not just another guru to you. I hope that's clear. All right, so anyways, my WTI, just this morning at around 7 a.m., we discussed being ready, willing, and able to buy WTI, waiting your turn, waiting for the signal, looking for the setup. You can't see it, but over here there's another bottom. So this is a double bottom. This is the second leg of a double bottom. And, you wait your turn. At some point, this makes a higher high, higher low, and you buy. Or it makes a higher high, higher low, and you buy. And that it's just a matter of waiting. Right on, guys. Yeah, right on, guys. Yeah, it's symbiotic. Just realize that. It's symbiotic. So I thank you back. My next vision is that 30 or 40, 50, 100 of us meet, and that I know you're all making money trading Forex and futures. So we're going to get a gathering somewhere cool, somewhere like South Africa in February. Right? And one of the requirements is I need to know that you're making $1,000 a week profit. Like, you have to show it to me in private. And so we get people in a room and we know everyone is part of the team, part of the crew. You're a subscriber, but I know for a fact you're making 50 grand a year profit in your pocket. And that would be like the minimum requirement to be in that group, right? And to me, that would fill me with pride and joy. And I think if you walked into the room too, and these are your brothers and sisters, making the same journey together. 40 years through the desert, and finally you've arrived at Eden's gate, right? Yeah. Yeah, I think that would be groovy. Well, yeah, why won't they quit? And that's the interesting thing. So in the past, that is what's happened, right? So I am going to build a platform where you won't want to quit. You will continue trading with the group, with the tools, with the platform. I essentially want to be the broker someday, in a sense, right? So it would be like the 100 of us actually work in one giant hedge fund. And let's say you keep 80% of everything you kill. You would stay because of the community and the team, and not just camaraderie, but the discussion dates, and I want to move away, in a sense, from training and coaching, and instead towards like your career, right? Yeah. So anyways, all right. So we can look at Bitcoin here. We've gone from the lower low to the lower high, which is mathematically expected. And we'll see if anything changes. Will it breach the two standard deviations and, develop a higher high? Like, it would look something like this. it would have to get to probably about here. Okay. And then it would probably come back here. And then, this way on the way to 100. Right on. Yeah, AR is like down with that. So really, I want to see I want almost to have a corporate structure where you're running a desk in my firm. And you have a team, you have resources, you have infrastructure, you have money. And we have corporate retreats around the world on a regular basis. And I envision giving out awards to people. So for example, on my own fund, I did analysis yesterday. So, you have to constantly track your numbers. And the beta on my fund is equal to 0.2, where the S&P 500 is 1. And what you're trying to do is, if you have too much volatility, you're going to come out 2.5. And what that means is the volatility inside your portfolio is 250% more than just buying the S&P 500. Well, that would be bad, right? If your portfolio jumps up and down, up and down, up and down, 250% more than the stock market, holy crap! That would be a huge red flag. Morning, Adam. I'm pulling over 6 months of investments. I'm pulling a 0.2. It's ridiculously good. It's ridiculous. A 0.2 beta sounds like I'm sitting in cash or something. And so that would be good, but then an investor is going to say, wait, but this guy's not performing. If he's pulling a 0.2 beta, he must just be in cash and there's no performance, right? No, that's not a Sharpe ratio. That's beta. Okay, now, my Sharpe ratio isn't good. Well, it's okay. But the Sortino ratio, okay? What most people are doing with the Sortino, which is a risk adjusted, it's different from the Sharpe. Now, Sortino worked with Bill Sharpe. So Sortino and Sharpe worked together. And what Sharpe said is you don't want any volatility. And Sortino said, well, there's bad volatility, but then there's good volatility. And you want to stay in when it's running your direction because you might have volatility, but it's all to the upside. Dude, you're making money, bro. Where Sharpe is too much volatility. Sortino's no, you want lots of good volatility, and you want and you want no bad volatility. So there's if you will, a subjective quality. There's a quality to the type of volatility. Okay? So they both worked on the Sharpe ratio. Bill Sharpe won the Nobel Prize and became famous, and Sortino got nothing. So he went off and created his own ratio because he saw the flaw in Bill Sharpe's idea that all volatility is bad. Sortino said some is good and some is bad. So anyway, so if you're analyzing a fund, so again, this is stuff that we did at Oxford. If you're analyzing an algo, you're okay, you want to do a risk-adjusted performance analysis, right? And so based on volatility and all that, how did the fund perform? And most of the time, a decent fund is pulling a 1.5, a 1.8. And if you get to about 2.0 or above, this is now in the territory of good. So someone come back to you and say, oh, our hedge fund is doing a 2.5 Sortino. And people would say, dude, seriously. Okay. But usually for something like that, that means your beta is higher. You might be like almost the same, which is a 0.8, or you might actually be higher than the S&P to catch such a good Sortino. So you might be a 1.25 beta, which means you have 25% more volatility than the S&P 500, but it's been good lately. So you've been you've been outpacing because of your higher beta, and that could lead to a good Sortino because you're catching more of the good. You understand? But I'm not running a 0.8 or a 1.25 on my beta. My beta is 0.2. It might be 0.24 or something, right? So like way low. So then you would think, well, then my Sortino is going to be, less than 2, right? So it probably, okay, I got low beta, but then I'm going to have a little bit lower returns because of my lower beta. Do you guys understand that connection? If my portfolio rarely moves up and down, then I'm probably going to underproduce because of the lower. The trick is if I jack up my beta, then when things are good, I'm going to have a high Sortino. But then when things are bad, I'm going to have terrible risk-adjusted performance. I'm going to lose a lot of money relative to the S&P 500, which is my benchmark, right? You understand that connection? Low volatility leads to low returns. High volatility leads to high returns or high losses. Everybody follow me? Everybody say aye. If I've lost you, please let me know. Everybody good? Right on. There's about a 20-second lag. Yeah, okay. Cool. Now, before I move on, let me ask you, of all the YouTube gurus, how many of these gurus give you this kind of knowledge of like the mathematical analysis of performance and portfolio construction and management? How many can get into the nitty-gritty like this? There's probably some, but what percentage know the stuff to this level? See, in my experience, you can't run a fund if you don't know this stuff. Like, this is the stuff I talk about with my buddies. They run funds, but you have to understand, we talk about this stuff because this is what the clients talk about. So when the clients show up and they bring their due diligence team, they're running these numbers on your analysis. So like they'll ask you, what's your Sortino? What's your beta? What's your Sharp? And no one needs to discuss anything. Everybody knows what all this stuff means. What's your risk of ruin, right? And they're going to run all these numbers on you, and you need to be like a professional athlete where you know your 100-yard dash. You know you have to understand how high you can jump, how fast you can run, how much weight you can bench, what you squat. Oh, I squat a 320. You know, like you just, right? Especially the portfolio matrix. Okay. So anyway, so we're going back to the portfolio, right? All right. So I'm pulling a 0.24 on my beta. And at first that's going to look good, but it's going to stand out. They're like, what the hell? See, to a due diligence team, they're going to look at this beta and they're going to go, what the hell? That's either great or it's bad. But they don't know what. So now they got to, because they're going to look at it and say, well, okay, a 0.24, we don't want the vol, but dude, we need a return. I mean, if you're just sitting in cash, you're like, I have low beta. Well, yeah, your cash never changes. But you're also not getting a return on investment. So they like it low, but you got to earn money. You got to have a payout, right? So anyway, so then they're going to look at your Sharpe and they're going to look at your Sortino. The reason for it is, we can compare apples to oranges. All right. So let's say I'm a fund manager, and David Pegler is selling a used vineyard in Napa, and you're the rich person, and you have to decide which is the best allocation of money. You can buy the vineyard and you're like, well, there's a lifestyle upside. But if we're going to compare money, you have to compare risk and cost and liquidity. And, you know, all these things are going to be important to you. And then you can analyze in similar ways this portfolio and you'll decide which is the best, because you can start measuring things like volatility and return, and you know, like your IRRs, your internal rate of return. So I tracked all my IRRs in the portfolio, and they're all in 10 months or in 6 months, they're all pulling each individual investment. They're pulling about 10% IRR. There's about 10% income and all that kind of stuff. So all of a sudden, you know, having these numbers showing the volatility relative to the return, you can compare an apartment building with a vineyard, with investing into rare whiskeys, and investing into the stock market, investing into a Forex trader. And you can compare apples and oranges to zebras and pigs, right? Cool. So anyways, going back to this, a 0.24 could be great, could be bad, but it's going to stand out. A Sortino in this scenario, you would expect to be 1. You're just barely earning enough money to cover your risk. 1.5 would be good in this scenario, and 2, just in general. 2 is great, or 2 is good, like a solid pass if you're pulling a 2. And then if you're like, but 2 with a 0.24 beta elevates that up to where you're being compensated for risk and you got very little volatility. You're like, dude, it's not the highest return, but I get it. You're cutting out the volatility and you're producing a beautiful return. So this would be a check mark. If you are an investor and you like low volatility in your portfolio and you like to be compensated for the risk you take, a 0.24 with a 2 on the Sortino is great. I'm doing a 5.1 and it's not even on the freaking chart. There's no space on the chart for a 5. It's like, holy shizer, holy. But then that's only over the last 6 months since I started this fund. But it's like, dude, you're doing a fiver with a 0.24 beta? Holy, like, absurd. They would have to do the math again. And that's what I'm producing. This is what we do at the CIA. Okay, the Council of Investment Advisors, this is what we do. But in the 6 months that we've been meeting, those are the results we're getting. And the interesting thing is, I think 13% of my portfolio is in 20-year notes. Excuse me. Okay. And the asset value, the net asset value of that investment, so of the portfolio, 13%, okay, that net asset value is actually losing money. It was as low as minus 10%. It's not as bad now. The income it's producing is averaging, okay, so now this is income, okay, is producing 12% annualized. So the total return right now for that investment over, I think I've been in it 4 months, the total return is about negative 2%. It's the only quote unquote blemish. But I'm holding those assets. And next year, I'm very confident that the net asset value will be up. We'll call it a +5. So we go all the way back to break even. Meanwhile, I never sold them, so I never actually took a loss. And let's say it goes from -10 to +5, but meanwhile, I keep collecting my 12%. And then this would probably go up, at some point significantly. And what does this mean? My risk-adjusted performance will improve even more. So it's just like, oh my God, oh my God, oh my God, oh my God, oh my God. It's crazy. Like when I'm running these numbers, even to me, and I designed it, is really hard to believe. And showing it to like investors. So I'm running my pension fund, and I'm teaching you guys how to do it. And then I now manage 3 endowments, and there might actually be another endowment that I take over. So, right? And then my next step in this is I'm going to manage your retirement account for you. And I'll be your fund manager. If you run a small business in the United States and you make $250,000 a year, I can mathematically design a program for your pension fund. So we are going to, I'm assuming you're incorporated. If you're not incorporated, we're going to get you incorporated. Then the second thing we're going to do is we're going to create a pension fund for your company. Now, you're the only person in the pension fund, unless you got your wife and kids working for you. And then we can get them in the same programs. Both my children are teenagers, and they have retirement accounts. Amazing, right? So anyway, so again, if you own a small business in America and you make 250 grand, maybe you're trading Forex, maybe you're flipping houses, maybe you're doing Uber on the side, but you got this income coming in. We'll get you incorporated. We'll open a pension fund. You'll contribute to it. You're going to lower your taxes, and you're going to retire a multi-millionaire, and I'll manage your money for you. And like I said, it's math. I can just, here's the math. You do this, I do that. When you're 70 years old, you'll have more money than you need. You'll die rich, and your grandchildren will keep your money and throw everything in your house into an auction. Okay? See, Eddie? All right. So let's go. Yeah, so that's the thing, AR. I don't know laws there. So the issue with the problem with my fund is I earn too much cash. Now I know it's funny. I mean, I know it sounds funny, but how do I have low volatility and a high Sortino ratio? I earn a boatload of cash. And this would be a problem. If you don't have a retirement account, then you're going to pay taxes. And you're going to pay a lot of taxes, like it's your job. See, this fund will be a job for you. This is where it gets even better, by the way. So if you don't have a retirement account in the United States and my fund is earning cash, you're going to lose 30% of the cash, 40% of the cash every year. You're going to get a tax bill. So you're not going to compound as fast as somebody with a retirement account. Because instead of paying taxes, they just reinvest. And then they earn more money because they earn more shares, which earns more cash, which then gets reinvested. So you own more shares, so then you collect more cash. And so it's, for one person, it's a real problem. You never compound and you get tax bills every year. And for the other person with a retirement account, it's growing so freaking quickly because it's like snowballing. You earn more money, so you buy more shares, so you earn more dividends, so you buy more shares. It's crazy, and it gets out of control. You're making so much money, it's stupid. But when you're 70, you're going to pay taxes. And it's going to be like a job. But here's the thing. If we compound your retirement account to a large enough number, you're earning a salary from your corporate pension fund. Think about it. It's like a salary now. So because, let's say you have $2 million in your retirement account, you live on $200,000 a year. Now you pay it's like a job. And now you pay taxes on your $200,000 a year. So when you're done and you're retired and everything, so I don't know what the tax situation is like when you're 70, but let's say now you pay 50 grand in taxes. That's going to happen. And you live on 150,000. And year after year after year, you're living on 150,000. You're paying 50,000 in taxes. Okay, whatever. Now, if you own your own home and you own these other things, maybe there's tax write-offs. But again, I'm not a senior citizen, so I don't know how that works. But there's things you can do. But nonetheless, you live on 150,000. You pay 50,000 a year in taxes. Here's the most amazing thing: we don't touch your money. So year after year after year, you're living on your $150,000 a year, but you still have $2 million in net worth. You're not. Most people, like your neighbor, when you're 70 or 75 years old, your neighbor is selling stock in their retirement account to collect the cash to live, to pay the rent, to buy medicine, to go on your trip to go see Pisa, right? Go to Italy, and you're selling your assets. And what happens is most people die broke, nearly broke. The last 2 years of your life, swallow up 80% of your net worth. With me, you will die a millionaire and you'll leave it to your children or to charity. And you'll have a dignified life, but you're never dwindling down your life savings. That's a hell of a vision. Yeah, Pigler brings up a point here, uncorrelated returns. That is definitely something that that may even be the number one question that they're going to ask is the correlation. If they invest into you, is it the same as just buying more S&P 500, which they already are exposed to that asset every which way but loose, directly and indirectly. So by giving you money, you're just doing the same thing in a different way. But when you look at things like you give them the track record and say, run the numbers, run the data, and you tell me, what's the beta of the portfolio? And they run their numbers and they're like, dude, you're a 0.2 beta. Yeah, when the stock market is crashing, this fund will lose a little bit. And you'll outperform. And when the stock market is rising, it'll do okay. It'll be very income-based. It won't do as well as the general market, but we're very focused on income. So most of your funds that are focused on NASDAQ and focused on AI and focused on S&P and focused on this, that, or the other thing, they're going to whoop us. But only in net asset value. We don't even really care about net asset value. It's a second or third thought in our process. You'll just own a boatload of income, which you can then reinvest and then own more. So we'll never beat the degenerate gamblers in a bull market. There'll be lots of outperformance in other funds. We're not interested. Again, if everything is going up, a degenerate gambler is going to do fantastic and it's just going to blow the doors off of us, but they are gambling. They're putting huge bets or huge leverage going, and they got it right. It was a good guess. But one day you'll wake up and their guess is wrong and you got yourself a crazy drawdown. That'll just never happen to us. Okay? So in this case, you're like, so we do all right in the up markets. Everything's good, but we have low vol. We're a low beta. But the thing is, we produce returns well above the risk that we take. So we have low volatility and high returns. And so, again, you can tell this billionaire or millionaire that's got all these other investments, you just say, well, when things are good, we'll hang in there. We'll do great. We'll earn you a lot of cash, and you can reinvest that cash. But when things blow up, you watch. Your stock investments are going to go down. Your real estate investments are going to go down. Your crypto investments are going to go down. Everything is going to go down until we get bailed out by the Fed. In the meantime, we'll lose a little bit, but we'll still be cash intensive. So the rest of the market might be down 30%. We'll be down 10%, but we'll be earning 10% in cash. So really, total return for the year will be 0 while everyone else is negative 30. But you get to keep the cash, and our loss is only on paper. So as soon as the Fed bails us out, the stock market goes back up. That negative 10 on paper goes back to break even, but we're still collecting the cash. We're still making cash. And so that's where you break that correlation. Where everyone else is crashing, or you're stuck in real estate that's illiquid and you can't refi, you're like, I don't have those problems. So this is going to be a great fund, but instead of making rich people richer, what I'm trying to do, and I haven't found, to be honest with you, I haven't found a way to do it yet. But what I would like to do is I would like to take people that are small business owners and have some money, have some career. You're definitely not filthy, stinking rich. But if you're making like $250K, like I said, you flip a house once or twice a year, you got some Forex trading going. So we'll incorporate all that. We'll get all your accounts corporate. I'll start a pension fund on your behalf, and I'll manage your pension fund, and I'll do all of this for you. And at least I can make your grandkids rich. To me, it's kind of interesting because nobody gives that sales pitch. I mean, look, all day, every day, millionaires and billionaires get pitches. Let me pitch you. I can make you rich. And they're like, I'm already rich. I can make you richer. It doesn't matter to me if I have 500 million or 600 million. Nothing changes, right? So after a while, it's crowded and boring, making rich people rich or helping rich people hedge. Really? So I think it'd be cool if I can take just regular old people that have a good old small business, which is a lot of people. And those people don't understand finances very well, not like a billionaire hedge fund, right? Manager, right? Type investor. So like if I can take someone that's like flipping houses and I'm like, dude, we got to get your finances in order. We need to incorporate all this. We need to flow everything into your pass-through, then into your pension fund, and then get these huge tax write-offs, and then compound the shit out of it for a few decades. I'll take care of you when you're too old to work. I'll take care of you when you're dead. All this will go to your children and your grandchildren or to charity. Like, let's get all of this set up. And it would make a massive difference versus just keeping rich people rich. I think there are plenty of people that can do that. The problem is that there's no money in it for me. That's the problem. I'm still trying to figure out how to pay the bills on that. A small matter, huh? Yeah, I can't figure out how to break even. Yeah. Anyway, so let me move my stop a little closer. So I'm wondering if we're gonna kick off the bottom here. Okay, it's 10:10, so we got the market open, but not a lot happening as of yet. Okay. Well, yeah, AR. So the typical is the 220, and I'm trying not to do that. So the number I'm trying to make work is a 0.8 and an 8.8. 0.88, right? So a 0.88 and an 8.8 instead of a 220. And in the beginning, I would most likely lose money. So an 8.8 management fee over an 8.8 performance fee. That's what I'm trying to make work. And the thing is, I don't really get to break even until it's like, I don't know, a little more than 10 million. Yeah, you're right, David, but they're not producing the returns. They're providing the low vol. So that's where, so like David makes, a lot of sense there. And that's why I've designed the portfolio to have a low beta, right? So you can also pick up a low beta from Vanguard. True. And most people want the low volatility, in particular because of the threat of the stock market dropping, and you're 80 years old, right? Yeah, I know what you're saying. I'm just explaining for everybody else, right? The worry is you're 80 years old and the stock market drops by 50%, and now they kick you out of your nursing home and you're living under a bridge selling your body for food money. So we want to avoid that. But we do want to avoid volatility. So I got the low beta. So I can compete with Vanguard. The thing is, Vanguard is probably producing a beta pretty close to 1 anyways. And what's the income on that? A 4? And so I'm doing like a beta of 0.24, okay, but the income I'm producing is 10. And that's where I win because, like I said, like when you retire, you should have $2 million. That's kind of the basic minimum. You should retire with $2 million. And that means I can pay you, because remember, I work for you. This is a business. Your pension is a business. It's like a company. Literally, it's kind of incorporated, right? So the business I run on your behalf will pay you $200,000 a year and never touch the 2M. Can you do that with Vanguard? No. It won't be enough. And then if you adjust, so if we have 2% inflation and you're earning a 4% income from Vanguard, you're only up plus 2%, right? Where these endowments I work for and these nonprofits that I work for, and I think what I'm going to do is I'm going to add like a dozen or two of these pensions. I'd like to do pro bono work in the future instead of working at homeless shelters and food banks like I do. I'd rather like run these pension funds because after doing this for 20 or 30 years, I think I'm pretty good at it, I guess is what I'm saying. So I can have a bigger impact. So if you're like a museum in a small town and someone has lent you or donated $1 million because someone in the town is rich and they like give $1 million to a local museum, okay, we put that in an endowment. Okay, and I can earn for it about $100,000 a year. Okay, and give it to the museum as a budget. So the budget now for the museum is going to be the $100,000 plus ticket sales, right? Now, if you're a small town, I bet you anything my 100K is a pretty significant contribution. But this allows, so let's say it's 50-50. So there's 100K in ticket sales from visitors and 100K from me. And now the budget, okay, the total budget for this museum is $200K. And that can pay for rent and for staff and air conditioning bills and whatever. It pays for stuff. And that's the difference where Vanguard can lower your volatility and give you beta. It'll give you a beta close to 1. But it won't earn the income. And so the reason you run an endowment is it has a different strategy. And okay, traditionally, what endowments do is they invest into alts. That's normal. So you invest into real estate, you invest into hedge funds, and other longer-term illiquid assets. So you get it from a long-term liquidity. But the downside is they do have a strong correlation with the market. So when the market crashes, okay, hopefully the hedge fund can hedge you and still earn income. But nonetheless, this needs to be achieved no matter what. And it doesn't always happen. So very often these alts overproduce in the good times and underproduce in the bad times, and then you then try to stretch out your cash flow, and it's cash flow management. So I do invest in alts, but I maintain liquidity. And it's a new style. It's a new style of investing. Okay. I don't know. I don't know, David. That's the easiest question. I don't know. But if I was setting up, so let's say I had a company and you come to me and you're like, I'm an entrepreneur and I'm making $350,000 a year. Can you set me up? And I'm like, yeah. Let's go through your docs. Let's get you, if you're not incorporated, let's get you incorporated. If you are incorporated, let's set up a corporate retirement plan called a simplified employee pension. So we'll set up a pension. And then I have to figure out, are you truly a solo entrepreneur, or do you have 1 or 2 employees? Can we add them to this? That kind of stuff. And there's some other types of questions, but we get that all taken care of. And then you designate me as the person that can manage money as you contribute. So if you earn $300K as a small business, okay, your business, if you're, after expenses, your company is bringing in $300K, we can reduce this immediately by $60,000. Holy shizer. So now your company only has $240,000 to pay taxes on. And then you pass that through, if you're an LLC, to yourself. And then you probably own a home and you can write off mortgage and all these different other things, right? But let's say after all your expenses, you have $300K. So you lower your taxes immediately, but this $60K goes into your pension. Okay? And we compound the shit out of that for 3 decades. And it's crazy because we're compounding it with that 10% cash every year. So you're compounding at 10% annually, and you're doing it 60 times 30, compounding at 10% per year. Fudgesicle. Does that become a lot of money? And in the meantime, we're just lowering your taxes by $60,000 a year. But because you're smart and you're see, when you make $300K a year, it's a form of rich. You're rich. You make a lot of money. Okay? You're not a Lambo driver, but you're rich. In many cases, I still call you poor. Like if you trade your time for money, so you're a doctor and you work 110 hours a week and you make $300K, I'm like, dude, I can make that kind of money if I drove Uber for 110 hours a week. I'd make more than you. So you're just a different form of poor. But what I mean by rich is you have a lot of income. Now, what most people do in this case is they pretend they're wealthy. So they have a huge house. Okay, they live in a McMansion. They drive a Porsche. Right? They go on Instagram vacations. Right? And they're like, great. And what do they have in the bank? Zero. What do they have on credit cards? 150,000. Negative. And they're just poor. Poor people acting rich. And you know who I'm talking about. That's most people. What I'm trying to say is, look, if you own a small business, you're an entrepreneur, so you're trading Forex and you're bringing home $300K, give me $60,000, okay, and you won't pay taxes on that. Not now. We'll defer your tax bill by 20 or 30 years, depending on how old you are. So now you pay taxes on 240. It's like you never even made them. Okay, you pay yourself before you pay the government. And I compound that at 10%. And you're putting in the $60K for 25 years, let's say. If you do the math on this, you will die wealthy. And what does wealthy mean? You make more money than you can spend and you don't do anything. The vast majority of your day is dedicated to either golfing or watching golf on TV. And you're making $1,000 a day sleeping in. You don't do anything. You don't frickin' do anything, but you make the $1,000 a day for free. It's just coming from the money. The money just makes you money. Your full-time job is owning money. So you're wealthy. You can't stop it. It doesn't matter what happens. Now that's wealth. And you know what happens when the economy collapses with those guys in the fancy cars and the McMansions. The stock market crashes and suddenly I can buy that house for 50% off. I can buy that car for 50% off. Ski boats and fishing boats, jet skis, pennies on the dollar in a downturn. Because people don't have the money when times are good, but they buy everything on credit. You see? So anyways. So, yeah, David's like, there's lots of plug and play. Yes, retirement packages. But what you need, okay, and there's a very particular trick for this, David, which most people don't know. So your average person doesn't know how to do it right. And even your average wealth manager doesn't know how to do it right. But if you, like I said, if you are a small business entrepreneur and you're making some half decent money, I can get you from rich to wealthy. And it's that simple. But it has to be structured right, and it has to be managed right, both on the investment side, but in the corporate structure side. And most people don't know how to do it. Yeah, that's the thing. So you need a combination of a bunch of different things. But imagine that's 60,000. Put it this way, like your maximum in a Roth is only a few $1,000s a year. A year. Like, who's that structured for? Hey, you should open a Roth IRA. You can save $3,000 a year. Who gives a shit? $3,000 a year. It doesn't do crap. You're like, that's it? Okay? So when I say I know how to do it at 60,000, holy schnickerschnocker. Holy schnickerschnocker. And it's just money you would have paid taxes on anyways. Like, it's in a way you lose 60,000 in income, but you're not paying taxes on the 60,000. So it's like you get $20,000 for free every year. So in 10 years, that's 200,000. Okay? You see? In 25 years, that's 500,000 right out of the gate that goes to your net worth that you would have lost over time in taxes. But the other 40 is also growing because it's been invested, it's earning income, and it's compounding. So the 40,000, let's say, but it's actually 60. So you got to go back to the 60. The 60,000 is growing at $6,000 a year every year for 25 years. How much is that? Okay? 6,000 times 25. Let's say you have 25 years to retirement. I just made you $150,000. What do you think you're going to live on your first year? I took your 60,000. Okay, that's just the income. But if the stock market then grows on average 5%, okay, then really on average, and the stock market grows much more than that, but I'm being incredibly conservative. Most people say 8 to 10. So let's say, okay, it's the 75,000, which is 5 times the 5% over 25 years, plus the 150,000, which is nearly guaranteed from the income I'm earning. This doesn't account for compounding. Because remember, we take, until you retire, we take the 6,000 but just buy more. So look, 25 years from now, and this does not add in compounding. This does not add compounding. It does not add compounding. Think about this. In every 7 years, this is doubling. I'm not even counting for that. Just straight up. That first 60,000 is worth 225. When you're 70, this number doesn't even quantify the compounding. Oh my God. Do you see? So you go from rich where, all right, you run a small business and you make a lot of money. So what? You're not wealthy. You still work like a jerk. Okay? So you want to get to the point where when you're 70, You don't even have to get out of bed and you make more money than you've ever made in your life. And you can't spend it. You never even touch the principal. Like, that's wealthy. Okay? And like Vanguard's not going to do that for you, right? So anyways. So again, I know exactly how to do it. The problem is most of you would be starting with pretty small sums of money, and it would cost me significantly more money to run it than I could possibly make. So if I charge you too much, then you don't compound as much. And I want, again, the end goal is I want your grandchildren to be filthy, stinking rich, aka wealthy, because of what I did for you. Right? Okay? So that's the thing. But if you roll in, you're like, Wayne, I got 100 grand or I got 50 grand and I want to start this. I mean, you end up paying me like $1,000 a year. My expenses would be $10,000 a year. Like, it would be such a money loser. And then for someone that's so new at this, the likelihood you're going to fail. You're like, you put in 60 grand the first year. The second year you put in 20 grand. And by the third year, you're not contributing anymore. Is so super high. So to me, it's like, I'm going to just lose a boatload of money. Because most people want to be rich. Most people want to be wealthy, but they just don't do it. So anyways. Sorry to be a pisser, but that's right. That's somewhat true, right? But who knows, right? My break-even point is somewhere around 10 million assets under management. Here's the thing, too. I know a lot of hedge fund managers, and they often get, non-institutional people. And so they do a pitch. Very often they'll do it like in a room full of potential investors. Sometimes they go to these like conferences, right? And they'll get on stage and they'll pitch 500 people on their investment opportunity. And usually it's for institutional investors only, but often there's just wealthy people, right? And so the wealthy person who's non-sophisticated, they say, well, I want to give you, $500,000 out of my retirement account. And my buddy's like, no. We're alternative investment that should not be applied to a retirement account. He gets a lot of these guys. They're like, we thank you for the confidence, but this is really structured for those that can take more risk, and it would be inappropriate for us to attach this to your 401k. Me, on the other hand, for sure, I'd be the best performing asset in that retirement account. I'm like, just give me your whole frickin' retirement account. Of course, I can't say that, but I'm like, yes, I feel confident. You invest into me, and I will take care of you. Yeah. Because I know it's appropriate. It's been designed to be appropriate. And now I have the proof. It couldn't be more appropriate. It's ridiculous. So, yeah. So I'll end up going that way where I need to find people that have, 250,000 to a million or two, that kind of, and they really need, ideally, their small business owners, because they might have money in this retirement account, and then they're like, but they're set up like a standard person. They're like, I can contribute $3,000 a year. I'm like, dude, that means you're compounding on $300. And how old are you? 68 and a half. I'm like, dude, all right, we're going to compound for 5 years at $300 a year. I'm like, dude, okay, I'll tell you what. You pay me $30,000 a year, and I'll go ahead and compound your $300. Right? And it just doesn't make sense to them. I'm like, well, it doesn't make sense to me. So you really kind of need someone that can be set up right. So that's why I thought like I could even set up a whole corporation that just goes out to small business and startup entrepreneurial events. So I find all these small business owners, and I'm like, you run your business, but you don't know jack about money. Let me get you set up properly. Push $60K aside out of your profits. Push it into a retirement account. And one day, when when you just simply don't want to do this anymore, I'll have you taken care of. Or if you're just worried about, the booms and busts, at least know that while you're in the boom phase, you're saving and compounding 60 grand. So if you have 5 years of downturn and you need to pause, go ahead and pause, but it's still going to keep growing at 10% because it keeps earning income. So if you have to take a pause for 5 years and you can't contribute anything to your retirement account, I'll keep it growing, bro. You can't eat from it. It's a retirement account. But I can keep it growing. And then when you get back on your feet and your business starts booming again, you can start contributing again. And that's cool. I like that. I can work with an entrepreneur like that. So anyway, we got a little bit of Oscar Mike going on here on the S&P. That's good. Another potential update. We're trying to make a higher high. That's good. Gold is stabilized. And let's look at gold on a 15. It's stabilizing. Maybe will go up. Silver is stabilizing. Maybe will go up. Oil's dipping for you. Remember, this is what I set you up for. So it's pretty close to do or die. You're either going to do it if you're a bull soon, not quite, maybe soon, or you're a poser. Dope! I'm a bull, but I don't want to buy it. Going over to the dollar. What's my target? I'm going to be in the S&P 500 for 30 years. So my target is 25,000. Yeah. So I don't have a target. It's up forever. Okay. We're stabilizing in here maybe. This is today's buy zone. Let me update my fib. No, that's not it. I'll update the fib. So we got a 50% pullback. So maybe, maybe we'll get rid of that. Maybe this is the news, right? The pop and the drop in the news. By the way, if you're not my day trading group, you probably don't know these things. I guess I can show you what I did. I forgot. How come you're not in the day trading group? You guys want to learn how to trade, but you're not in the day trading group. You need to join the day trading group. So I'll show you on this 5-minute chart. I guess I'll get rid of this. I made my point anyways. Okay? We traded CPI together yesterday, and CPI skyrocketed to that candle. Then, over the next hour to an hour and a half, okay, it collapsed. And I bought it. I did this across the board. You see the 5A cross on a 5-minute chart? Dude, this is exactly how I taught you how to trade at Investor Bootcamp. It's so easy when everybody's trying to please me, baby. Yeah, that's how you were taught to behave. I just want to show you that it's precisely on a 5A cross, on a 5-minute chart. RWA, ready, willing, and able. But on many trades, same thing, over and over and over and over. Just sort of silly. Okay, you see this one? Up on the news, down, buy it on the 5A cross. Gone, baby, gone! Okay? So easy, nothing seems to please me. Yeah. Look at the yens. It's inside Investor Bootcamp, Mike, under the section of MT4, MT5 downloads. Yeah. Okay, not the greatest pattern in the world here on the kitty cat. Very wedgy, and I don't like wedgies. Look at Aussie. Okay, neat little op here. Okay, as you can see, my stop is way down here. My entry is just above. I'm long at 101.5. We're at 103.5 and rising. Cool. It's an out of position trade, but we didn't get to target early. So I'm just hanging in there, hanging in. Kiwi didn't look that good to me in general. I missed an entry here by like a pip right in here. You see it? I said, if it gets to this price, I want to buy it. But it got to that price. Oh, the money I could have made. Well, too bad, so sad. What's going on here? Beautiful little retracement. Okay. Okay, it's a trap and break type strategy. Up, 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 up. Down, down. This is a buy. I have 2 lines highlighting it. I have a purple zone highlighting it. Okay? Oh my God, like, you either have the plan or you don't. You know what I mean? Look at it. The drop on the news and then long and gone. You're either a bull or not. If you were a bull, you had that set up. It's a very standard trap and break. So it broke, okay, and then you catch the pullback, long and gone, and now you're in it to win it. If you missed that, then you didn't have it set up. It's just that simple. Beast. Okay. Look, I understand. This is insane volatility. I get it. If you're not on that, dude, I get it. I get it. That kind of vol is just frightening. Okay. Good vol, bad vol. Sorrentino vol, sharp. Bill Sharp, bad. Everything is bad. So, wowzer. Yeah. Take a look at the global stock market. Gapping up really nice for me on this one. So I'm long the Chinese stock market since February. Yeah, since February. Well, one of the things that you guys have been working on, or at least investor boot camp members have told me, that one of the things, and we talked about this at the beginning of the year, and I asked for people to tell me what some of their goals are for 2024. One of them was to hang on to trades longer. I'm like, cool. So I bought this and I said, I'm going to hold on to it forever. How about that? There you go. Right? So how do you feel about me, right? About being long here. And this is our current price up here. Seems pretty good, right? If we back out to a daily, I'll show you, it's a double bottom. And we set it up all in advance. I actually lost the first trade. I had to re-enter here because I lost the first one. But when you see this and this, don't you think like we should at least get above this number? Okay. And what if we can get back to here? Well, it's going to take me 5 or 6 years. Okay. Well, I'll see you in 5 or 6 years. So we've gone like this little itty bitty bit, but it's doing all right. Don't cry for me. Yeah. Anyways. So again, this is what we do at Investor Boot Camp. Okay, that's how we set it up. Let's go back to the U.S. stocks. And then I forgot to do crypto. Oh, crushing it, huh? Crushing it. Look at the indices here. Yeah, dollar may be weakening on the roll reversal, which I'm happy for now. We're risk on, bro. Cool. Oh, I just wanted to see what we're on. Yeah, so we're not quite there. All right. Oh, crypto. Okay, let's do crypto. Cryptos. I need to update that. It bugs the heck out of me. Okay, so what was it yesterday? What I outlined is we want to see a higher high, higher low, and now somewhere around this zone. Remember, I picked it from this pivot, and not pivot point. Okay, it's a fractal in the market. And then this one, and then bring it back around. So the theory now is on Ethereum, I sit on a 5-minute chart and I wait for my signal. You understand? It's game on. You see this pink zone, or purple zone, or whatever you want to call it? I drew it for you yesterday. We needed a higher high yesterday. Yesterday we got a higher high. Then we needed a higher low, so it needed a fall. Now it has fallen. We don't want it to fall too much further in this purple zone. We're in the purple zone. So if you are a bull, you got your finger on the trigger. Is now the time? No. What about in the next 2, 3, 4 hours? Yes, that's your job. Wait. Do it right. Be a boss. Take control. Stand for something. If you're going to do it, then sit and be prepared. But I've done all the analysis. I've drawn out a double bottom. I've found all the support and resistance. I identified the higher high. I identified the higher low. Now you sit here and do your job. Or I don't know what you do, to be frank. Is this a buy now? No. Okay. Well, what if in the next 2 hours we get a scenario like this? Oops. Okay. Then if I were me, I'd be long bombing around here. Is it happening right now? No. So you wait. What if you waited all day and didn't get an entry? Well, A, your trade plan was wrong, and B, you're hardcore disciplined. So what's the problem? You waited all day and you didn't lose money. Good. Good for you. Okay, that's what I want. I want to see you be patient and disciplined. Wait for it. Look at this, right in there. Look at that. That's so beautiful. Wait for it. See, you should almost draw it like 2 little zones. Okay, it's 2 little zones. And you're right in the zone. So again, I just sit here all day on my 5-minute chart looking for any reason to buy. Do I buy lower lows? Never. Never gonna buy it, 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 ever buy it. Whoa, whoa, whoa! Yeah. So I need a higher high, higher low. And I will wait all day like a sniper. Okay? But I'm coming home to base alive. If I don't get a shot, I don't get a shot. That's that. If I don't get permission, I don't take the shot. If it lines up, I fire for effect. That's simple. And when the markets are good, what I mean by fire for effect is this idea, and it's very American, but it's this idea, if you drop one mortar, that'll do the job, drop 10. Yeah. There's a great war movie, I don't even remember which one, but the idea was to go into Norway and sneak into a plant where they're making heavy water, which would be useful to the Germans to make an atomic bomb. Now, the Norwegians were doing this to make fertilizer, but nonetheless, the Germans found out about it and they're like, ooh, we want to take it over and take all the heavy water. So they do. They enter Norway and they just take over Norway and they take over the plant. Well, the Allies can't have that. So Norway's like, well, we're going to send in 3 guys on snow skis in the middle of the night and we're going to sabotage the plant. And the Americans are standing there. They're like, what the hell are you talking about? They're like, yes, we'll send in 3 guys on skis and we'll sneak in the middle of the night past all the Nazi guards and we'll plant a bomb and we'll blow it up. And the general of the Air Force is more like, hell's bells, we're going to send in 150 B-27s and B-32s and whatever, right? We're just going to send in and we're just going to drop massive payload on it, right? And, of course, the Norwegians are told not to go, and the Americans are going to bomb the shit out of this valley in the mountains. And the Norwegians are secretly like, you know what, we're going to go anyways. We're going to do it anyways. But the Americans come in and they just unleash this massive payload and they just scatter bombs all over the valley and all over the mountain and simply wake up the Germans. They didn't even come close to hitting the target. They just bombed the shit out of the valley. Anyways, fire for effect. Yeah, you can send in 3 Norwegians with snow skis, but why not just bomb the shit out of the whole valley? So anyways, what I'm trying to say is, like yesterday when the market was moving, you needed a fire for effect. If you normally make 2 trades, you should have made 10 trades. How are you supposed to make money with no vol? You can't. So when there is vol, you got to trade it and you got to make money. So anyways, I'm tired. I got to go. I'll see you at 4 o'clock for the swing trading meeting. Remember, go to investorbootcamp.com. Join. It's $88 a year to be a member. And then you'll upgrade your account to $99 a month. And there's a pretty good chance, like Coldplay would say, I can fix you. Have a nice day.